Welcome to today's Director's Table on the Omnibus reform. My name is Pierre Schlosser. I'm an assistant professor of political economy here at the European University Institute. And it's a great pleasure for me to welcome today Agnieszka Smolenska from the London School of Economics, CETEx, a newly established center. You are a senior policy fellow there. And Nathan de Arriba-Sellier, director of the Erasmus platform for sustainable value creation at Rotterdam School of Management. Agnieszka and Nathan, the Omnibus package was introduced in February 2025. It includes proposals to alleviate the burden on undertakings arising from the so-called CSRD, Corporate Sustainability Reporting Directive, and the Corporate Sustainability Due Diligence Directive, also called CSRD, and to reduce and simplify the obligations under them, and to postpone some requirements. Additionally, the Omnibus package contains proposals to simplify obligations under the taxonomy regulation, proposals to simplify, to use a word we're going to use today, the carbon border adjustment mechanism, CBAM, and reduce obligations under it, as well as simplifying and optimizing existing EU investment mechanism. Now, the package consists and contains several parts, and in this interview, we will focus on so-called Omnibus 1. So starting with both, to start us off really, and for listeners who might not know, can you please explain to us what the Omnibus 1 reforms are, and crucially, what key problems, starting with you, Agnieszka, what key problems these reforms are trying to fix? How do they fit into the bigger picture of EU financial regulation and financial stability and oversight? But you can also choose who answers first, that's fine.
Sure. So what is the Omnibus 1 package? You said it yourself, is to reduce red tape, simplify the Corporate Sustainability Reporting Directive and the Due Diligence Directive, making changes partly in the scope of the Corporate Sustainability Reporting Directive and in the substance of the obligations that are in the Due Diligence Directive, but it will greatly reduce the obligations that derive from them.
The biggest difference, just to add on this, is that it limits the scope of the companies that are going to be reporting. There are also some smaller changes regarding the scope of the requirements, and kind of thinking a little bit more broadly how it fits into the bigger picture of EU financial regulation. There is clearly quite a significant domino effect because the CSRD data, the data that was going to be reported under CSRD, is so connected to other pieces of the EU sustainable finance puzzle. So you can think about the financial sector that has been waiting for this data for several key reasons. First of all, we had, and we will come back to this in the context of discussing risk management implications of this reform more broadly, but CSRD data was intended to be a credible source of information for the financial sector to integrate the exposures of companies to climate change, environmental degradation risks. It was going to help the banking sector with the Pillar 3 reporting requirements. So since 2022, the banks, large banks across Europe, now also the smaller ones as well, are obliged to report their climate change exposures, and this CSRD data was going to feed into those processes as well. We were also in the process of really the financial sector looking to incorporate this CSRD data for identifying opportunities linked to the transition, which is key. So this was also about the data underlying the development of financial instruments, sustainability-linked loans, sustainability-linked bonds. So this wasn't just about the risk and burden. This was also about then developing the carrots for the system to invest in climate change mitigation and adaptation. So quite a lot of changes that we can delve into. We knew that there was a lot of pushback against these reforms, which admittedly were comprehensive and were imposing quite a lot of obligations on the real economy actors, but this also was reflecting the scale of the challenge that we are facing, right? So, we are used to talking about climate change, for example, like it's something long-term, 2050, but increasingly this is something that we are experiencing in the present. So, the fact that we limit the scope of data availability doesn't mean that the risks will go away, and that's maybe the biggest concern with this reform proposals.
And you're very much portraying an entire sector, the financial sector, that was looking forward to really and preparing itself to an area of data that would be coming in. So we'll go back to this in a few seconds. Nathan, also staying at the big picture, do you consider that the reform proposal, will it help, will it hinder the general climate objectives that we have in the EU?
Well, as it has just been said, climate is not going to go away because we ignore it and because we stop reporting about it. And so, in this sense, the problem is that the reform will hinder climate goals, the achievement of climate goals, because suddenly companies that had to report on their climate risks as well as their impacts on the climate, so their achievements in reducing greenhouse gas emissions, will no longer have to report about those. So there will be less corporate climate accountability, and also that's for the Sustainability Reporting Directive side, but the Omnibus 1 proposal affects as much, if not more, the Due Diligence Directive. And the Due Diligence Directive provides today that large companies have to adopt and put into effect a mandatory net zero transition plan. That means that they have to make a plan to transition their business model to net zero greenhouse gas emissions by 2050 in alignment with the EU's climate goals. And that specific provision will be weakened as a result of the proposal of the Commission. We don't know what the Parliament will do and the Council will do. Maybe they will preserve this provision, perhaps they will undermine it further, and that will affect further the achievement of the climate goals. But the result of this proposal, no matter what, will be indeed less corporate climate accountability. And as a result, perhaps less action, less discerning or ability to mitigate climate change, despite the fact that it won't go away.
We will stay on the corporate side for quite some time during this interview, but before we go there, what about the impact of Omnibus on financial stability, Agnieszka?
Right, so I already touched upon this, that financial sector was really looking for this data because of the risk management requirements, but also to identify opportunities linked with climate change mitigation. So we know that climate change and environmental risks are material to banks, right? They impact on the ability of the creditors to repay their loans. They impact on the value of the collateral that banks take, and also on the macro macro situation more broadly, so inflation, etc. And banks so far do not take into account these factors as much as they should. So the absence of this data will really impact on the bank's ability to price these risks accurately. And we also have, ECB, for example, doing various macro stress tests that show the magnitude of impact. But we know that, the problem is that these are not stress tests that are about testing extreme scenarios. The climate change impacts are now baseline, right? And we are still not properly integrating this into risk management. So from that perspective, it's important to kind of take a step back and remember why it was so difficult for the financial sector to take into account climate change and environmental factors. Why, despite the materiality of these risks and financial impacts, banks have been so far failing to properly account for this. And typically, there are three arguments that are given. The absence of reliable data, backward-looking nature of the methodologies, and the excessively short time horizon. So let us not forget that a lot of the prudential frameworks work with with 2, 3, 5-year maximum time horizons. Now, what the data reported under CSRD was going to do, and also the CSRD transition planning requirement, was precisely to, address these specific gaps, right? So this was about reporting of data related to current performance. So that's addressing the data gap issue, but also critically CSRD, through mandating the disclosure of bank transition plans across the real economy actors, and CSRD introducing this requirement of transition plans for largest companies more broadly, was also providing banks, but also other real economy stakeholders, with this forward-looking information about transition planning, about the actions and strategies that real economy corporates are implementing with this longer-term time horizon, right? So there is a clear risk that without the accurate economy-wide data, banks and other financial institutions will continue to underprice the risks related to the transition. And even worse, that they will start to rely more or continue to rely on what we know are imperfect proxies. So the fact that we are limiting the scope of public reporting doesn't mean that the need for the data will go away. It's just that this data will become more private, it will become more costly, and it will become less accountable and transparent. It will also make it more difficult for public authorities, both on the financial sector side, but also on industrial policy side, to make informed decisions, right? Because this data just will not be available. And that's why it's, just a few days ago, we had a quite important intervention in this debate from the European Central Bank that published an opinion on the Omnibus proposal, where you can really see the scale of the concern of the ECB as a supervisor of the largest banks and as the monetary policy authority of the European Union, with the impact on financial stability and on the ECB's ability to perform its task if the proposal goes ahead as per European Commission proposal. So in that opinion, and I think it's important to recall, ECB is pointing to many issues with the proposal, but I think 3 are particularly important. First, that the proposal will really create an even regulatory field across the economy. So you will end up with a lot of uncertainty about which banks are covered by which requirements. In fact, the CSRD's proposal to limit the reporting obligation only on the companies that have above 1,000 employees means, in the ECB's view, that several of the significant banks in the EU will not be captured by reporting requirements. And this clearly has a impact on ECB's, from the ECB's perspective on the level playing field, but this also has an impact on, how the relationship between the clients of these banks and the banks will be impacted. Second, what I already mentioned, the absence of this data will make it more difficult for prudential authorities to engage with bank transition plans specifically. And thirdly, and I thought this was quite an interesting part of the ECB's opinion, as regards monetary policy decisions and integration of climate change and environmental risks in monetary policy decisions, ECB pointed to the fact that it has been waiting for some of this data to deliver on its monetary strategy commitments to integrate climate change considerations in its market operations, in its collateral policy, and that, so that also the domino effect that I mentioned before is quite broad.
If I may add on that, because what Agnieszka said is entirely true, but it doesn't just apply to banks. You can also think about the economy as a whole. And what we see in the economy as a whole is that if we limit reporting to those companies that only have more than 1,000 employees, which is the proposal of the Omnibus Directive, and such a very high level of revenues, then we don't capture a very broad share of the economy, that is highly GHG intensive, and we do capture those sectors and companies that are lesser impact on the environment or on society. So we are get blindsided into the landscape or state of corporate greenhouse gas emissions and environmental impact, as well as risks. And so if we don't readjust the scope, at the very least at what it is today, which is more than 250 employees, and we, like the CSRD, aim to capture more of the economy with SMEs in the longer term, then we don't have a good picture of the economy as a whole and the risks for the economy as a whole, and that impacts, of course, financial regulation and monetary policy and economic policies.
Absolutely agree. It's just a misunderstanding of what proportionality is, right? It's like proportionality is not about like limiting by a set number of percent or making some arbitrary lines, right? It's about it should be about the scale of impact and really kind of different thresholds than the size.
Agreed.
You're both legally trained. And I can see that indeed there is really a tension between the proportionality principle, this new objective of simplification, and the other objectives, which is one single internal market with one level playing field, and the public data that is required for financial stability purposes and other functions, as that you outlined, Agnieszka. Now, on simplification, I'm a bit looking at the track record of the European Union when it says that it's going to simplify something, for good reasons probably. I mean, we're in this together. It's compromises. It's 27 member states. But I have in the back of my mind the Stability and Growth Pact simplification, which if you ask 10 people, I'm pretty sure that 9 people will say it's not particularly simpler than it was before. So what's your expectation in terms of simplification? Do you expect that the legislatures will reach that first in terms of the agreement, but also after, once the omnibus is adopted, will this be reached on the ground?
Yeah, I think for having a good understanding of whether this proposal will achieve the simplification, one needs to take a step back. Where were we before Corporate Sustainability Reporting Directive, before the Corporate Sustainability Due Diligence Directive? And where we were was a situation where companies were asked by investors by nonprofits to comply with a variety of frameworks to provide data with different methodologies on different data points, very contradictory with contradictory objectives. And so there were already reporting burden imposed on companies, but this was from investors, nonprofits, the civil society, and what the EU did with the Sustainability Reporting Directive was already simplifying that by setting one core set of data requirements, of reporting requirements that would apply across the economy. Mm-hmm. And that was also a simplification. We are in the EU after all, and these proposals were all adopted on the basis of the internal market in a situation where member states were already putting forward their own regulations on reporting. France had its own. There was big talk about the Article 174 back in the days and the effects of that on reporting, on biodiversity and climate risk. So it was really like harmonizing, simplifying at EU level one core set of reporting requirements. So that's the situation. Then the thing that was highly criticized and that I think the Omnibus is trying to address is that the European Sustainability Reporting Standards, the ESRS, that were adopted on the basis of the CSRD, went quite far in requiring a lot of data from companies on impact and risks, because this is double materiality that is provided in the law and that will remain with the Omnibus. Still, if the Commission wanted to simplify things, what it could do is require change in the ESRS, just like it is asking for change in the taxonomy level 2, so below the legislation, the applicable regulation that is adopted on the basis of a legislation. It doesn't do that. It doesn't require more proportionality, even in the taxonomy. What it proposes, de-scoping, simply enough. It's almost a simplistic view of simplification. You just de-scope, you take companies off the scope of the CSRD and things will go better. No, things will probably go back to status quo ex ante, through which companies will have to report to their investors, but also because the CSRD applies across the value chain, they will still be indirectly affected by the CSRD, and it will make things perhaps more difficult and make things more uncertain from a legal standpoint. And that's the same for the CSDDD. Because the CSDDD is even worse, I would say, because the CSDDD would not change much in terms of scope, but it changes, at least in the Commission proposal, it makes changes to some phrasing of requirements. It takes off the civil liability provision of the CSDDD while keeping a lot of other provisions that were related and connected to that beforehand. It removes the obligation to put into effect mandatory transition plans, even though companies still have to adopt those transition plans and take immediate action on this basis. So the risk is not more simplification, it's less certainty and more complexity for companies in their compliance efforts.
And that has an impact in terms of the type of data that will be available. I mean, we mentioned earlier this notion of publicly available data. There is this tension, in my view, between public and private data. Some actors were already preparing, I guess, on the marketplace for this data to be available under the CSRD. Do you consider that first movers will be penalized? And more broadly, do you consider that an entire ecosystem of data providers that are really thriving right now will keep on thriving or thrive more to push the question further?
Yes, and to some extent it was a criticism of the CSRD that it was a law made for consultants and data service providers, and that their business will thrive at the expense of the general economy. But that's not exactly what we see. Companies, there's this famous adage, you can't manage what you don't measure, and that's where the problem lies. Like today, companies have, with their reporting efforts, found out a lot of information that is useful to their business model, to their business activity, and suddenly they're asked to undo that, or at least not to do it anymore. And so that's where the data question, and I was at the Climate Week organized by the European University Institute actually not so long ago, where companies were telling me in hard to decarbonize sectors, so really directly affected by the omnibus, that, well, they did not understand what was happening. They were in this under the threshold of 1,000 employees, but above 250, so they are already complying with CSRD. They will be complying for the next 2 years, and suddenly after that, they will no longer have to comply. They spent enormous amounts of money and energy trying to report that data, find out that data, and suddenly this is no longer useful. So they make investments that will be rendered useless by the Commission, and that's where really the problem lies. It's not just that we'll have less information. You undermine companies' efforts by creating an unstable legal environment, and I think today we have enough political and legal uncertainty and instability not to add on that. The European Union should stay the course and make sure that we have the information that these companies need in order to have thriving business models, in order to minimize legal risks from litigation, from also supply chain risks. That is important for them.
I would maybe add to this that there might be an expectation, I can imagine in Brussels, is that this is an amendment that goes towards towards meeting the expectations of those who are really against the Green Deal. So this is about meeting these people halfway, and that those companies that were really at the forefront of the sustainability transition, that they will continue to do this regardless of whether there is a regulatory framework in place case or not. I think this is a very risky bet at the end of the day to make, right? Because we shouldn't also underestimate the chilling effect that this has on implementation and changes within the organization. The way that this really damages trust in EU law as something that is stable. You know, just a few years ago, we were discussing indefinitely and like all the time, the Brussels effect, how the quality of EU regulation leads to these regulations being taken up globally because of specific properties of EU law, including kind of how it's done in a consensual way and therefore is applicable across a broad variety of contexts. And this is really not that, right? So I think the effect on kind of the trust in EU law broadly shouldn't be underestimated.
Do you want to pick up?
Yeah, one final word. Like, because of that, companies will be able, like companies that fell below the new threshold, the future new threshold, whatever it may be, will be able to cherry pick the information they provide to investors, will not be required to adopt stringent and exigent assurance requirements. And you also have an unlevel playing field in the EU. At least for financial reporting, there is a rule that if you are a company that is publicly listed, then you have to report. If the amendments of the Commission go through, you will have companies publicly listed on the same stock market. Some will have to report on sustainability issues, others will not. What will be the level playing field within the EU and also vis-à-vis other countries all over the world which are adopting rules of the International Sustainability Standards Board, which will at minima apply to all those who are publicly listed. Great.
So that calls for difficult enforceability of the omnibus generally. Would you like to comment on this?
Yeah, I think already enforcement of reporting rules in the EU is suboptimal. We're not the United States where the SEC, the Securities and Exchange Commission, is the cop on the playground with a big stick and can force companies to report. We don't have private enforcement of reporting rules whereby investors can say, well, you did not report on that and go to court to make sure that companies are diligent. So if we do go through, first of all, we have this period of uncertainty, this 2 years whereby some companies are expected to report or are already reporting that they may not report in the future. What will regulators do about that? Will they require reporting by those companies? Will they be lenient? And also, to which extent can this regulators prepare for their own role? I know that, for instance, the authorities that were preparing, the regulators that were preparing for the application of a CSRD, the due diligence directive, today themselves are in disarray because they invested already some of their scarce resources in getting expertise, in preparing for the application of these rules, in making sure that we'll be able to enforce them, and suddenly they don't know what will happen to these rules. So enforcement is already undermined. It will be also in the longer term because it will be much more difficult, especially for this value chain reporting requirements, to apply them with due diligence if there are few companies that are within scope and the others you only have indirect ways to get to them and to get them to report that information that the companies that are in scope need.
Yes, this is well taken. Our time is almost up, so I will finish with one final question, Agnieszka, on let's say not philosophical, but going back to, let's say, the roots of the EU sustainable finance agenda. Do you consider the omnibus to be a complete U-turn in that agenda?
I mean, I think I mentioned already the domino effect and the trust destructive dimension of this. But I think it would be helpful maybe to recall, as you point to, indeed, why we are introducing this, right? So we know that climate change is happening. Environmental disasters have cost like 300 billion in the last year. These are financially material, right? But also, in this fragmenting world, EU is really looking for its competitive advantage. It's looking to build up its resilience in different dimensions, for sure defense, but also environmental and climate change is also about resilience of our economies and looking for our competitiveness in this more unstable world. So with that in mind, thinking about the omnibus impact and kind of maybe reopening a little bit the discussion given the various controversies and the signals from different capitals that these laws will not be implemented in a timely manner, even if they stay in the current form, is also something to take into account. So if I'm being incredibly optimistic, and maybe this is also something that we can finish on, like how can this process of omnibus revision not throw out the baby with the bathwater, and how can we repivot some of the discussions to reminding everyone about this competitiveness, resilience, and environmental origins of all of these rules, right? So this wasn't about consultant business, right? This is about material dimensions of business activity and their impact on environmental and social aspects that can be at the root of European competitiveness and resilience in the long term. So we can think of a few different types of issues that should be brought up into this discussion, and I will just name a few. And there is further research that we've done also at the LSE on these topics, and of course at the Florence School. And in Rotterdam. But what I would draw attention of the policymakers to is to think about enhanced coordination in implementation and enforcement. This is for sure needed, and we can think, for example, EBA published these guidelines in January of this year, and in the annex there is a very clear linkage made between CSRD and some of the ESG risk reporting frameworks. This is the simplification, showing how things interact and are interoperable, rather than limiting the scope and saying, these guys report this. A consistent interpretation, so facilitating or engaging to the extent possible EU-level agencies, but also facilitating coordination from national competent authorities in market conduct, for example, to support their consistent interpretation, but also guidance to market participants on how these rules are to be implemented. Definitely closing regulatory gaps, so thinking about increasing the consistency of interpretation of key concepts like sustainability, aligning some of these procedures across reporting, corporate governance, and risk management, thinking about how we should support SMEs, not by taking them out of scope of regulation, but thinking how to support the uptake of technological solutions. This is, we are having this discussion around the omnibus like we are in the 19th century, we are in the 21st, right? There is technology we can use. AI is out there. Maybe this can be helpful rather than just limiting the scope. And also thinking about really how to use this data in different ways to inform policy, also maybe to build up more of the carrots. So thinking about how this data should be implemented to, in the financial sector, design financial instruments priced correctly, in the sense of offering favorable pricing conditions to the firms that want to invest in the transition and increased environmental and climate change resilience, as well as in the public sector. And of course, we are at the verge of a big discussion around the MFF, and this is definitely something that should be integrated in that discussion too.
The multi-financial framework discussion. Closing words?
The burden is high. No, I think I just want to pick up one thing we discussed earlier. It is about proportionality. It's Agnieszka who said that. If we want to simplify, and there's still time, the EU legislature's debate on the omnibus, it's just starting. So there's still a lot of uncertainty for even us here around the table about what's going to happen. But if the EU legislature wants to pursue simplification, they can make rules more proportional. That is going through mostly level 2, but it doesn't require descoping. It could be that there is more materiality thresholds, for instance, for SMEs, that they are required to only provide information on the core set of data requirements, and that would already provide both satisfy investors' needs, the economy's needs, banking objectives, and provide for simplification less red tape. And I think that would be a better goal. And even on the taxonomy itself, the Commission can do that now. It doesn't seem to be taking this way. Maybe it should consider that a bit strongly.
Nathan, Agnieszka, thank you very much for this really insightful interview.
Thank you very much.